Hey YouTube, welcome back to My Financial Focus. In this video, I want to talk about how we can get paid to open up a call debit spread. Typically with a call debit spread, we're going to be paying a debit in order to open the spread. That's why it's called a call debit spread. But there are situations where we can actually collect a credit in order to open up a call debit spread, which would make it so that we can profit even if the call debit spread expires out of the money. And we can also realize our max profit if the call debit spread expires in the money. So in this video, I'm just going to explain how we can do that. So the first thing that I want to talk about is how to buy a naked call option and just how that whole process works in terms of max profit and max loss. And that's pretty straightforward. Obviously right here, if I were to just buy this call option, we can see this is our long call position. And how this would work is we would spend $11.45 for this call option. With options, we're dealing with 100 shares, so whatever this value is, we multiply it by 100, so our total cost would end up being $1,145. And so in order to profit from this call option, as long as the share price of the underlying asset increases, the premium for this call option will also increase in value. So we can see as the strike prices increase, the premium increases in value as well. So if the share price were to increase above 120, then this 120 strike call option would be where this 115 call option currently is. And so the value would increase from about $1,145 to $1,408, and then so on. If it increases another $5, then it would increase to $1,713, give or take a couple of cents. And then obviously the max loss would occur if upon expiration date in March 18th, the share price was underneath the strike price for the call option that we bought, then it would just expire worthless. And obviously as we get closer and closer with each passing day to the expiration date, the premium of the call option loses value equivalent to the amount of theta decay, as we can see right here. So with each passing day, this call option will lose 7 cents of value. So if the if the share price doesn't move at all, then the call option will decrease in value from 11.45 to about 11.38, 11.37, around there. So now what I want to talk about is how we can profit from selling a call option. Because remember, when we open up a call debit spread, we're buying a call option and selling a call option at the same time. And so selling a call option is pretty straightforward. Let's say I were to sell this 125 strike call option. How we would profit from this is, as long as the share price of the underlying asset is beneath the strike price of the call option that we sold upon expiration date, then we'll just get to keep the maximum credit that we collect from selling this call option. So when we buy a call option, we are paying the total cost in order to buy it. But if we sell the call option, then we are collecting the total cost that somebody else would pay us to buy this call option. So somewhere else in the market, somebody is buying this 120 strike price call, and we are the ones who are selling it to them. So they're paying us $1,145 to buy this. And in order for them to profit, the share price has to increase. In order for us to profit, the share price has to stay beneath the strike price of the call option that we sold. And if that happens, then the total credit that we collect as soon as we sell the call option, we get to keep, as long as the share price is underneath the strike price on March 18th. Pretty straightforward. So now I want to talk about how a typical call debit spread works. And typically how this would work is we would buy and sell a call option at the same time. As we can see right here, this opens up a call debit spread. And the reason that is because we're buying a call option for $1,145 and selling a call option above it with a strike price that is greater than the strike price of the call option that we bought. We're selling that call option for $925. And so we end up incurring a debit, a total cost in order to open this up, because we're paying more than we're collecting. We're spending $1,145 and we're collecting $925. And so that ends up, after we subtract it, comes out to $220, which is what we would spend to open up this call debit spread. And so the max profit ends up being the difference between the strike prices. So 125 minus 120. Remember, when we're dealing with options, we're dealing with 100 shares. So we multiply these values by 100. So this would really be 12,500 minus 12,000, which would be 500. So that would be the max profit that this, well, not the max profit, but the max equity that this call debit spread would have on expiration date if it expired in the money. And then we just subtract whatever we spent to open up the call debit spread. So the max profit here would be $280 because it's 500 minus the 220 total cost, right? So typically this is how a call debit spread would work. We would spend money in order for an opportunity to make money. But there is a situation where we can actually get paid for an opportunity to make money. So that's basically what I'm going to talk about here. And how that works is basically we're going to want to open a transaction where we're getting paid. So we're collecting a larger credit than the debit that we're paying, but we still want to buy a call option that has a strike price that is lower than the strike price of the call option that we're selling. And so typically in order to collect a credit, let's say somebody was opening up a call credit spread like this, they would buy this $925 call option and then sell this $1,145 call option. And that would open up a call credit spread because we're getting paid more than we're spending. So we would collect a total credit of $220. But the way that we can actually collect a credit in order to open up a call debit spread is simply by legging into the call debit spread one leg at a time at different share price values. So to put that simply, let's say for instance that we bought this $120 strike price call option and then we just held on to this call option. So our total position after we buy this would just be a long naked call position, right? So let's say a couple days pass by and the share price of the underlying asset, in this case Alibaba, were to increase to say $130 or something, right? So it would be above $130. That would mean that the call option that we bought, which is this 120 strike, it would move down, like this moves up 1, 2, 3. So this would move down, like, let's say it moved down to around like 110 or 105, right? Basically, this premium would increase in value from 1145 to 1408 and then to 1713 and then to 2038, right? So if the share price increases, then the premium of the call option that we bought also increases. So that's good. After the call option that we bought increases in value to, let's say, about 2008, we would then want to sell the call option that has a higher strike price than the call option that we bought. So if we bought the 120 strike, then we would sell the 125 strike. But keep in mind that as the share price increases, the value of every call option on this options calendar would increase in value, right? So the call option that we bought for $1,145 would now be here. It would be worth $2,038, right? And so the 125 strike call option that we're trying to sell would now be worth $1,713. And so if we were to sell the 125 strike call option when it's worth $1713, what this call debit spread would effectively look like is it would say 120 call 1145, 125 call 1713. So we would be selling a call option that has a higher strike price than the call option that we went long on for a higher premium than the call option that we went long on. So we would basically essentially be opening up a call debit spread while collecting a total credit of the difference between the premiums of our long call and our short call. So in this case, if we went long on the 120 strike call for 1145 and then we went short on the 125 call for 1713, then that would come out to be about $600, $500 to $600. And so we'd be collecting a total credit of about $600 for opening up a call debit spread. And so what does this mean, right? Once we have this trade open, how can we profit from this? Well, let's say, for example, once we have this call debit spread open and we've collected a $600 credit in order to open it, upon expiration date on March 18th, if the share price of the underlying asset, in this case Alibaba, were to decrease beneath the strike price of our long call, that would mean that our long call would expire worthless, so it would be worth $0. But remember that when we sold the 125 call option, we collected a credit of 1713. And so even though both of these call options would expire worthless, even though we're losing $1,145, we're collecting $1,713. Because remember at the start of the video, I talked about how the way we profit from selling a call option is if the share price of the underlying asset is beneath the strike of that call on expiration date. So the credit that we collect from our short call will fully cover and also result in a profit over the call option that we went long on for $1,145. So worst case scenario, if the call debit spread expires out of the money, we collect the total credit of $600, right? And so if the share price then in another scenario were to increase above the strike price of our short call, above 125, that would mean that our call debit spread expired in the money. And so we would experience the max profit or max equity of the difference between our strike prices. And like I said before, that would be $12,500 minus $12,000, which would be $500. And then we would just add that value, the max equity, the $500, to the $600 credit that we collected for opening up the call debit spread. And so in this case, our max profit would be the difference between the strike prices, so $500, and then plus the total credit that we collected to open up the call debit spread. So the total profit would be $1,100 if the call debit spread expired in the money. So if the share price was above the strike price of $125. And so that's basically how we can get paid to open up a call debit spread. It's a pretty interesting strategy. It's very useful, very practical, but it's also a very risky strategy because, of course, in order to open this strategy, somebody would basically have to just open up a naked call position, which is obviously very risky because there's a lot more chance for max loss, as well as the fact that because it's a naked call option, the theta decay will continue to eat away at the value. Whereas if we were opening up a call debit spread and shorting the call that was above the call option that we bought, then the theta that we collected from selling this call option versus the theta that we would lose from buying this call option would essentially cancel out. And so that would make it so that the effect that theta decay had on our call debit spread would be very minimal in comparison to if we were to just buy a naked call option. So it's a risky strategy to open up, but it's definitely one of those strategies where it's high risk, high reward. Like, subscribe, all that good stuff, and I'll see everyone in the next one.